16th of September, the weekly expiry. We had a hell of an up move, and at this point, it's just expected that anyone who is short the market, if you buy put options or sell naked call options, you have to get slaughtered. I think initial part of the expiry, I wasn't too happy with how I managed it. I think I should have had a little bit more of a risk appetite on the puts expanding and let them expand a little bit. I was too preemptive in trying to manage that. And that backfired a little bit because after that we had tremendous short covering on the calls. And into the second half, I was quite happy with my management, all said and done. And all put together, it closed up a little more than 0.5%. And on a day like this, I'm just happy I got out without getting hurt. And there was no point that I took any undue risk in my position. So it was very much in control the entire time. So that being the case, the biggest people who are a little bit stuck up are people who have shorted calls and companies like ITC, Reliance, and basically any company at this point, SBI. So anywhere you've shorted calls, you're really bleeding. And the first part of this video, I'm just going to go over like how to manage those bleeding calls, depending on what your trade is. I got quite a few messages. Some people have covered calls, but they don't want to give deliveries. Some people have strangles, which have got slaughtered. Some people had naked shorts, in which case they're basically just screwed at this point and need to cut their losses. So I'll go over what can be done to manage these trades. That'll be the first part. In case you're not a positional trader and this doesn't really matter to you, you can just skip ahead to the expiry. Thank you so much for watching. Take care.
Want to meet like-minded traders and discuss option strategies, adjustments and more? Just type in Discuss Nifty in your Telegram search box and join the friendly trader community.
Okay, let's talk ITC. Now let's talk call shorts in general. Now, the first thing you should do if your trade goes wrong, if it's a naked trade that you've taken, it's a put long or call short, book a loss. Like, you don't have to fight that particular trade. Like, when you have a position that has gone this drastically against you, fighting that trade most of the time is as good as creating a new trade. Like, it's like, why are you in that trade? Is it because that you were already in the trade, that you want to continue managing that trade and have to come out of that trade only profitable? Are there no better trades that you can take? First thing, cut your losses, right? If you can't, and if you had a hedged position, then I'll talk to you about how you can adjust it. First kind of position that most people had on ITC was covered calls, right? They own ITC shares, or they're holding ITC future, or they had a deep in the money call option, and against that they sold a out of the money call option, right? Now I have some okay. So this particular person sold a call option at 220. Okay, so ITC 220 call option. He, assuming that he has sold it at previous close of 2.35, today is trading at 16. That's gone up 8 times. But let us say you have the underlying, you have actually achieved the maximum profit in the trade. So you should be happy that you've achieved if this was a covered call. And if you want to give delivery, give delivery. But this is the same problem with everyone who does covered calls. They don't want to give delivery. They wanted every month that premium. But when finally their call option went in the money, they don't want to give that delivery. I'm also that type. I also don't like giving delivery. But what I do is I keep a lot of my margin available so that I can come out of not giving delivery as well as the futures and option trade profitably, right? So, but for example, let's say you don't want to match this position. There is something you can do called a rollover. This is trading at 13. Assuming you sold it at 2 rupees and it's gone to 13, you are booking a loss of 11 rupees. So you need to collect 11 rupees. What do? Go to the next one. Go to ITC 230. You roll up. Now currently ITC is at 230. So this is the at the money call option. 230 October call option. You are getting about 12 rupees 45 paisa. What does that mean? You booked a loss of 11 rupees on your F&O position, and you have again sold this call for 12 rupees 45 paisa. So effectively then at that point, you, in case ITC goes down also, you have the protection of this call. And in case ITC continues to move up, at least you won't have given up your shares. And there is potentially another 12 rupees 45 paisa that you can get. This is called a rolling forward and rolling up. Now, depending on how much you want to be protected on a reversal, you can choose a higher strike or a lower strike. You can also roll forward, but generally it is preferred to roll forward and up to whatever is at the money or out the money. You don't want to roll forward and up into in the money because then basically you won't really be getting much extrinsic value. So that is the first part for people who have covered calls, who had a fully hedged position that was actually going to benefit and they don't want to give delivery. Now, the second kind, there are people who have done strangles and ITC. Strangles and ITC is something that I personally never understood, because ITC has such low IV and you don't want to strangle low IV. You want to strangle when there is expectation of volatility, not when there's absolutely no expectation of volatility. But let's take a look at this particular trade, right? So he shorted 205 put option of October and 230 call option of October at 215 and 275. Let me make this trade. Okay. How you would manage this trade depends deeply on how much margin you have. If you don't have any margin, cut this trade. Cut this trade, give up on it, forget about it, and book your loss. Like don't do. There are other things that you can do where you can now bring your put at the money, and then all kinds of mumbo jumbo that can be done. But that's basically a new trade at that point. Why are you sticking to this trade? Okay, you think IV on ITC is very high, you short that IV. That can be a particular trade, but this trade, if you don't have additional margin, definitely it has to be booked and you have to book a loss on it. You should get out. Okay, now let's say you have a lot of additional margin. What is the first thing that you need to do? You need to control the bleeding on this call. So for that, you need to have additional put side credit. You need to be able to sell this particular put option. That is the first thing that you'll do. Because IV is high, you'll get some pretty good premiums, and then you need to probably add additional DK to this position. So you can add another straddle at basically martingaling your straddle at 230. You can add another straddle, or you can add a strangle if you want, where you look at the breakout level. So you can say 215 is the breakout level. So say 215 is the breakout level. You sell this put option and you sell call option, which is roughly the same price. Okay, something like that. Now you've sort of overpowered this trade a little bit with capital, and you can only do this in high quality. I mean, ideally I do adjustments like this because most of the time I'm holding the underlying also. So an up move actually doesn't have too much risk for me. And if it goes to my lower break even, I don't mind buying it and then fixing the trade that way. So this is a way of sort of overpowering a trade and basically adding forcible amount of potential decay that you can get in the range. So this is one way it can be adjusted. Basically, to adjust your call which is at the money, you will have to sell an at the money put, but the price at which you would have sold the straddle would be quite low. So you need to add additional straddles or additional strangles to do that. Now, in case you're expecting a move, there can also be stuff like you can add broken wing butterfly, but it's too late for that. Like after this kind of a move, after this sort of a situation, it's too late for you to actually make any real adjustments like adding a debit call spread or by moving up your puts at different point of time. It's too late. Your one premium has gone up 8 times. So either book the loss or you dump it with capital and you try and manage the trade. And stocks like ITC, you can do that. Let me go over one of the trades where I actually did this in this month. So this was my Reliance trade. I took this covered call position on Reliance when Reliance was at 2160. At that point, my first leg of the trade was selling this 2300 call option for 20 rupees. This position is losing me 1.12 lakhs just from my cover. Of course, you have to understand my shares have gained by that much. They have gained by a good 300 points almost. And so that being the case, if I don't want to give delivery of my Reliance shares. It's my largest holding and I plan on never giving delivery of that. So I added similar things. So I basically moved up my puts, added positions that would give me additional decay in this range. Yes, compared to what was the initial margin required for this trade, which was somewhere around 3 lakhs or something. Now the margin required is 30 lakhs, right? But I've now ensured that my F&O position comes out in profit. If Reliance continues to go higher, actually my upside risk is zero because I'm holding the shares. If Reliance heads lower, yes, around 2,300, I will have to purchase. I will purchase. That's not a problem. Against that, I'll again sell calls. I'll manage that position in that way. So yeah, there is a difference. That's also kind of why you shouldn't use all your margin to enter your trades. So let me go over another position where my covered call is bleeding and what I intend to do there. This Larsen position, Larsen is at 1721. I sold this call option on Larsen for 16 rupees when Larsen was below 1600. Now it is trading at 40. I'm making a loss. Of course, the position itself is benefiting because I'm holding the shares. What I plan to do is nothing. I believe the Larsen will continue to consolidate in this price range. And towards the end, if my call is in the money, I will roll it forward to the next month, the first part that I spoke about. If you have any specific doubts, like apart from this, I've tried to cover just a brief amount of things that can be done in case a covered call is bleeding to this extent. Look, if your covered call is bleeding to the extent that it is with ITC, either you have to overpower it or you have to just cut your losses or give delivery basically. And if it is to a small extent, you can try to take additional put side credit. You can add a bull put spread where basically, for example, to this Larsen position, a particular adjustment that I can make. Okay, so for example, this particular Larsen position, your shares would have benefited, so that's good, but now you're losing on the call. So one thing to do is, one thing you can do, depending on how aggressive or conservative you want to be, is the same 2 lots of call option that you short. You short the put option at the money, making an inverted triangle, increasing your upside break even, but now you also have a downside to worry about. If you are too conservative and you don't want any downside risk whatsoever, because you'll also have downside risk on the share, you can purchase an out the money put option to make it a bull put spread, right? So you basically created a bull put spread at the money, so that in case there is you basically get more room on your upside and you have limited loss on the downside. The other thing you can also do is you can also completely decide to cut off your upside unlimited risk on this F&O position by buying an OTM. Making basically at that point, if you do it in this manner, it becomes an iron condor. But you basically buy 2 lots of OTM calls so that your upside risk on the F&O position is capped, whereas the upside profit on your particular shares is unlimited. Technically, you're already in a deep profit on this position. So these are a couple of ways. If you're expecting IV to rise, you can create calendars, though that is another way of managing it. You can just, if you don't mind dealing with, you can, one more thing is you can make this a short strategy, which is basically instead of selling at the money, you're saying out the money, right? Because now 1700 is out the money. You can sell 1700 put option. You can sell this 2 lots. Now it's become a short straddle here. And in case it continues to head higher, that put will anyway give up all its value. Your call is perfectly hedged. And later, as we reach the monthly expiry, you can square off the call and roll it forward or whatever in that manner. So, if anything, there are 2 things to take away from here. One, always have hedge trades, even if it's like really bad hedging, have some kind of hedging. Second, if your trade goes against you, most of the time, the best thing to do is cut it. Third thing is, when something goes against you, if you're not able to cut it, first thing, at least cut off the risk in that direction. You have bleeding call, buy a call. You're bleeding put, buy a put. After that, you can figure out how you can play around with that trade and try to come out of it profitably. But these are like a few things. You can also do other stuff, like for example, you can create a broken wing butterfly structure. Now, broken wing butterfly, basically what you do is you sell an at the money straddle. You sell both these options. You purchase a hedge in the direction of risk that you're currently facing. You purchase a closer hedge there, and you purchase a much further away hedge on the direction where you are not losing. So what this does is, basically if you remove this call option, this trade will show you how this looks. Now it is taken as sell, is it? Okay, the buy. Okay, so what this does is, on the upside it gives you limited profit, on the downside it gives you limited loss. In case there's a upside continuation move from where your current this thing is, you have at least some amount of limited profit that you'll be getting. Since I've short 2 lots of call, I would in that case take 4 lots roughly, and this depends on you. This completely depends on how or what kind of risk reward you like and how you have this thing. So in conjunction to this current position, it would have given me some more room on the upside because I have some limited profit on the upside. I hope this was useful to you. Some trades are too far gone. You can't fix a trade that is gone against you, 8 times. The premium is trading at 8 times of what you sold it for. You can't fix such trades most of the time. So, to do it, you basically require a lot of additional capital and whatnot. But I hope this was useful to you. And now we'll move on to the expiry. Good morning, ladies and gentlemen. The time is 9:50, and we opened today with quite a gap up, mainly from Bank Nifty going absolutely bonkers at the start and taking out 37,000. Reliance is flat and ID is flat to weakish. The global cues as well are quite weak today. No particular reason to show so much strength, especially after yesterday we made such a big rally onto the upside, and despite that we opened with a lot of strength today. So more or less right off the bat, people who were short 17,500 calls and below, they started to unwind and started moving their calls to 17,550, 17,600, and there is a quite large amount of 17,500 put writing, making 17,500 maximum put side open interest as of now. So good 80 lakh. And on the call side as well, 17,600 is maximum open interest. What's interesting is that at the beginning itself, the straddle pricing of 17,550 was pricing in only about 60 points of risk. And as of now, it is pricing in much lesser than that, so like 56 points. And if 56 points up and down is the risk that's being priced in, then my position here, which is 200 points wide, should be very comfortable and should almost require no management at any given point of time. So my idea is I will not be managing my put options until we test the opening low, right? So until we test here, I will not be making any change to the put option. And on the other side, until this call doesn't expand to about 6-7, I will not particularly be concerned about taking additional put side credit. So that's the plan, more or less, that the market is pricing in very little risk. So I will keep my risk spread much further away than what the market is anticipating. And as and when there is an opportunity, I will try to capitalize on that. I have the room to increase my sizing as well, and I also have quite a good range as of now. The idea is sail through the first half of the day in a relatively risk averse manner, and later look for opportunities as and when something can be capitalized on. Okay, the first part of the risk management played out. We took out the opening low, and immediately I've moved down my calls to 17,600. This now it makes sense for me to do that. Otherwise, I would have completely imbalanced credit between my put leg and call leg. Now, let's say we continue to slide. We continue to slide, and we are just about. So ideally, where I think the people would start panicking is just as we test 17,500 on the downside. These puts will really start to be in a bit of a panic. And as and when these expand to about 11-12, I will, about exactly at 12, I will take this and move it to 17.4. Square off the put and roll it low. But I'm expecting a bounce of 17,500. So I'll not be in a rush to do that. I will let this expand if required. And I have good amount of credit from my call side. So it is alright for me to sit into a little bit of pain on the put option. So the market does what the market does, because went into test yesterday's close 17,500, but there was a lot of put option writing, and then unseated, whoever had to be unseated, expanded the put to about 25, and then from there we saw a bounce. Now I waited basically until we came back to the center point where straddles were building in the morning in order to take additional put side credit to balance the fact that now this call has regained its value. So more or less the straddle is pricing in 50 points of risk, and this triangle has about 20 points, and this triangle is sitting at maximum open interest. And so the point at which I will adjust this position is if the value of this particular triangle starts going above 24, 25, and that is the point at which I will adjust it. Otherwise, I will not adjust this position, because there will be swings here and there, and that will over management will just lead to me taking bad trades each time I try to manage the risk. So I will have to let it expand in case it does expand. But so far, going by the straddle pricing of just slightly above 50, 52, it doesn't look like there should be too much of a threat to this position. But yes, very realistic that at some point either of these options expands to about 18, 19, 20 if there is a big swing in that direction. And yeah, it's been quite intense. Bank Nifty made that dip, pulling us down, and from there immediately made a 200 point up move. So yeah, Bank Nifty would have been tricky to trade, because there would have been many people thinking that 37,000 should act as some kind of ceiling, but yeah, it doesn't seem to be the case. Anyhow, little bit of an expansion now on the put. I think I entered it at the worst possible price, but it's okay. For now, I'm only going off of what is the strategy pricing. Also, ITC is completely rocketed out of control today, and that's very good for me because I'm holding ITC shares. It is up a good 7%. Some pretty insane short covering on ITC, and with a large volume. So I'm expecting realistically that 17,250 now is very much 250 now is very realistic on ITC, And what might seem a little counterintuitive is that I sold the ITC 250 call option on a positional trade. That's because I'm holding ITC shares. These would have gained immensely. And once there's no way I'm not going to sell these, so I'm not going to be locking in any profit. So instead, I've sold a call option which is out the money at this point of time by 20 rupees. Right, 20 rupees, it's out the money, and it's giving me 3 rupees. And either I keep this 3 rupees credit, or ITC actually heads higher, and then I'll have to manage this call. But it means that benefited on 3,800 quantity, I would have benefited those 20 points. So that's the trade. And this is just selling a call option is kind of like partly booking profit kind. To keep you posted, time is 10:22, and so far we are basically exactly where we opened. And so going by today's advanced decline, the advanced decline is actually in the red. Only about 15 Nifty stocks in the green. But the thing is, IndusInd Bank and ITC, both of them together have absolutely smashed the decliners, and they individually have ensured that Nifty is in the green. IndusInd Bank benefiting from the fact that Vodafone most likely will not be defaulting. So whatever shorts are there, at least those getting covered. Oh, okay. Circuit. Intense. Very intense. So this is more or less what is keeping the index holding range. And Bank Nifty as well. The people who had trades on the Bank Nifty, they would be having to deal with quite a lot of pain, because during the entire week, I think an assumption that everyone would have made is that Bank Nifty was looking weak, and 37,000 looked like a pretty decent place to short calls. Then 37,200 at least was a pretty decent. I mean, it was agreeably decent to short, and people would have expected this to hold. And because at different points there's pain on the put side, they would have, when this happened, definitely they would have thought, okay, this is safe to sell. But yeah, they would be bleeding on that in this point of time. Anyway, my position more or less is at cost. I'm still following the same idea that the maximum open interest most likely is to hold, and that on this position I'm willing to take about 5 to 6 points of pain in case there is a move in either direction. But we'll have to see what happens once IndusInd Bank circuit unfreezes. That is also another thing to consider. Okay, it's basically impossible to sit on the maximum open interest position, simply because if I keep taking credit to balance moves, invariably we are pulling back, and at the same time it is kind of difficult to sit on a mark-to-market loss, as you see a slide and there's no credit left in your other leg. So it will be back to hoping that things hold. And since my risk tolerance is very low, I don't want to sit and let my options expand without having a counter position. So call it what you will. But to deal with this, what I've done is I've just taken off the risk on the entire max OI position. I've kept the call side the same, but have moved down my put option to 17,450, giving me basically, after removing my hedges, about 9 points in this position. And I'm going to keep this as it is until this 9 points starts to expand to something like 12, 13, and then I'll see if any changes have to be done. So a couple of things to note. Bank Nifty absolutely bonkers with the move today, and people who have shorted the 37,000 would have really got burnt. 37,000, 37,200 both had a good amount of positions. Reliance making this down move, but I have a feeling this is more to do with index management than anything else. I have a position on Reliance, and currently that has a positive delta. This covered call was initially bleeding. I had to restructure the trade, and this is where we are. My idea is I'm not going to make adjustments to it today. I'll wait and see tomorrow if the weakness continues in Reliance. If that's the case, I'll bring some of my calls down and increase my lower break even at least by about 30 to 40 points. So that will be the plan for tomorrow. Today I will not make any changes to it. I think Reliance is being used to compensate for the fact that Bank Nifty is going bonkers. IT as well looking quite weak today. So looks like money is exiting IT and going into banks. Yeah, for now this range looks good. As far as open interest is concerned, one would think that 17,500 itself should not breach today. 17,500 should not breach, and 17,600 should not breach. approaching 1 crore open interest on 17600. And with the relative weakness in IT and Reliance, I don't think it will be possible for us to take it out. And yeah, the question will be how much more upside can come from Bank Nifty. That's the only thing. And yeah, we'll keep you posted. We're at almost 11:30, and as of now, I am currently down on the sizing about 2 points, and I can gain about 9 from this position as things stand. Hedges are really expensive, so that's another nuisance. Okay, some big moves from Reliance, making 30-point move almost to head back to 2400. That combined with the fact that Bank Nifty is absolutely holding on to its high levels is putting these calls, is making these calls expand. But what I'm more concerned about is I'm looking at these 17,550 calls, and they're trading 24, being 10 points in the money. So there's really no panic there, and the straddle continues to trade below 50. Then I don't see any point of doing anything to these calls in this point of time. I will wait for the day's high to get taken out, and when the day's high gets taken out, I'll move my puts to 17,500. And if we then start to test 17,600, I will cover these and I will switch to this. But from that, I won't be making any change now. I won't preemptively also move up my puts, because clearly what is ending up happening is we're making small moves from 17,550 and then pulling back every time to 17,550. Even with this strength in Reliance that has popped out of nowhere and this volume building, I don't think we'll be heading too much higher than 2,400 today. So I think that would be most likely, with the kind of open interest that is now sitting on 17,600, along with the fact that even the 17,550 guys are not particularly too concerned about this expansion. I'm not very bothered by the fact that this is taking place at this point of time. It's not even halfway, it's just about 11:55, and I will keep you posted. Okay, looks like that theory went out the door very quickly, because Reliance is now rocketing really out of control with building volumes. So moved up my puts to 17,500 now, and once again back to being at either side maximum open interest. The idea is that with the expansion that the calls have seen, as we have a pullback, let's say, of 20 points, these should give up more than what these gain by, and I should get the opportunity to then roll them back down. Because the premiums are so low, it becomes really difficult to sort of deal with these whipsaw moves. And yeah, so I think this is the second time I've gotten played. So we'll keep you posted. Time is just about 12 o'clock, and as of now I am down about 3 points. Okay, so this is starting to become very annoying day. I had to cover my shorts on the 17,600 call. I managed to cover it at something like 17.4, 17.5, 16.9, so in the 17 range, and I moved them up to 17,650, and I also moved up my puts to 17,550, because this kind of strength that is there in Reliance today, suddenly out of nowhere, that sort of gives you the confidence that all of these gains will not be given up just as quickly, this kind of a move. So more or less now, with my puts being here and my calls basically having absolutely no credit, the idea behind this is I want once again these calls to expand. After I exited, there was a red candle that completely crashed the call prices. Ideally what I want now is an up move, where I will, what I'm expecting is that there will be further short covering on the 17,600 call option, and that's why I'm sitting with this kind of an imbalance. Now if this goes against me and this put expands to about 16, I will once again move my call back down to 17,600, and I will take this and roll it down to 17,500. That is the plan. Definitely an annoying day today. There has been completely no premium in the options, suggesting a very tight range, and I guess you can say the range is tight, but the problem with low premiums is that it's difficult to have a balanced trade that gives you protection in some range. To keep you posted, time is 12:33, and we're holding absolutely at the day's high on Bank Nifty and Reliance. IT is looking weak, but it looks like more or less should have bottomed out over here as of now. Okay, so into the up move, I actually ended up being a little opportunistic and moving down my calls. and I'll just go over why. Basically, I was sitting on 17,550 put short, 7650 call short. These went down to as low as 6. Now, when they've gone as low as to 6, then in case there's a down move, these calls won't really gain much and lose much, and this put will gain back as it has gained back 2.5 points right now. So at about 14.15, I shorted the 17,600 call with the idea that if I'm shorting it at 15, I will cover it at 20, and meanwhile that will also give me some protection on this put once again regaining value. Let me just go over how that looks. So this went down till about 6.5. At that point, since there is really on a reversal no credit in my call to give up, I moved it down, and that was sort of an opportunistic trade. And basically right now I'm sitting on a 50 points triangle with most of my position, and if I have a stop loss on this of 20, and right now my concern will be the stop loss on this, and I would also be exiting this if it is starting to expand to 15, 16, but that will take a while because there's still on the upper side of this small range that I have, and my idea will be to stay in this position as long as it is losing value. The moment the position starts gaining value again, I will have to make some shifts and adjustments. Another thing is I have to keep a very close eye on what is happening with the 17,600 put. In case that starts to see heavy shorting, I will probably have to get out of my 17,600 calls. We're heading to about 1 o'clock, so there will be 2 hours left to go for averaging. Currently, I'm sitting on this 50 points triangle, which is holding a little more than 20 points in it. My hedges have 2 rupees 60 paisa. So let me see how much of this I'm actually able to translate. The time is 1:30, and we continue to hold at higher levels. There is 30 points of value in the 17,600 put option and 10 points in the 17,600 call option. Now, my idea to get out of this call option will be if it expands to 15. Currently, the spread is trading for just lost value, so about 16, a little bit more than 16. If either of these options expand to 14, 13, 14, what I'll do is I'll square both of them off and move both of them away. So I will move down to the 17,500 put option, which will have 2 rupees, almost nothing, and 7,650 call option, which will have 1 rupee 50 paisa, once again will have absolutely nothing. The idea will be to kill the trade, and then because there is still about 1.5 hours to go for averaging to begin, and then the idea will be into averaging, see if I can pick up some credit, and like there is a good favorable trade to take. So that's more or less how this whole thing is going to pan out. We've been holding range for a while. Reliance is now making this lower high, lower low situation. Bank Nifty is holding just below 37,400 at this point of time. Okay, we're making an up move, and there is a threat of these getting covered, so I had to buy back half my quantity of calls that I'm short. And the other thing is, every time I make a change, I have to pay to slippage. So even though the price when I place the trade might be 12.5, 12.6, 12.7, a trade will only execute at much higher prices. So because of that, anyway, gave up half the quantity at 17,600. It's not worth dealing with any expansion here. I do not want to sell the 17,700 put. That becomes then a far too high a risk reward position, when I am of the opinion that while this might not have too much downside, it's very realistically possible that we expire close to 17,550. So I don't want to sell this put option for 25, 26, 27, whatever price it is available at. I will rather just move away my call side so that I don't have that kind of an exposure. So I removed half. Now this expands to about 15, 16 thereabout. I will remove the other half also and move it here. So that is where things stand at this point of time. Currently still down about 3 points, but this is not like, okay, I have to end in the green or anything. I'm fine if I have to end in the red. As far as I'm concerned, it makes sense to hold these puts as long as there's this much value in this call. If I end up removing this call here and moving it here, after that I'll restructure the trade so I can take an appropriate exit as and when necessary. But so far, I guess more or less in control, considering that I got played quite badly from the beginning, first on the downside and then on the upside. Okay, I'm going to be exiting the remainder of the 17,600. not because it has particularly expanded, but the way things look as of now, even if temporarily I want to exit only, price will jump by 1 rupee. This is me causing slippage to myself to a large extent, but apart from that, the market is also moving. Yeah. Okay. So at this point, my idea is that these straddle builders, right? People who've started selling the 17600 put to deal with that bleeding call will sort of lead to a point where we might head very high, quite high, and then you'll see some kind of a panic expansion as we are now seeing on the 17600 call. Might expand by quite a bit. My put doesn't really have much value anymore, so that is not really going to give me any protection. So I've just squared off the call, rolled it higher, and at this point my position has a net credit of 5 points, just slightly above 5 points, and I'm going to keep this as is. Now if there is some reversal and then these puts are tested and they expand to, I would think, since my triangle itself is trading at about 7, if they expand to 7, then it would at that point probably be safe to sell the 17600 call. Today has there's just no money in extrinsic value of options. So I mean, if we're pricing in 60 points of risk at the open, we make a good, how many points is that, from the first 5-minute candle high to the day's low is a good 70 points, and then from there we make a close to 100-point up move. That's just, yeah, not much can be done about it. So anyway, from the threat that is there in these calls, I once again exited them and moved them higher. Okay, the time is 2:10, and basically right now my triangle is perfectly centered. We made that up move to 17600, and yeah, the calls are not really expanding, but the put option, the 17600 put option, absolutely lost all of its value. It is halved in the last 20 minutes or so. Now here it comes down to basically why did I not take the approach of making that 17600 straddle rather than moving away my call to 17650 and not moving my put up. Very simple. At my sizing at this point, I'm just not comfortable. First of all, I've not had a great day from the beginning, so it's not like I have a positive buffer. If you see in my last week's expiry, I was up a good amount. I was up about 10-12 points, which is when I took a relatively high risk trade. Now, when you're down and you want to increase the risk in your trade, it's not a good idea, which is why I would rather take risk off and then have to deal with the fact that, like, for example, the same point when I rolled up my call, had I shorted this 17600 put, in case there was a down move, my call wasn't really going to give me any protection. In case, rather than, yes, there's a lot of positions building up here, you can naturally assume that it's been bullish the entire day, and invariably in this market, it's just bullish, right? It just goes up every day. So, but instead of making this up move, if you made a down move, then that 27 could easily go to 40 very quickly. Like it doesn't take much. And my call had itself some 12 points of credit. So what sense? I mean, it's a good trade because you have the analysis in place. And also, as I'm exiting a position, I'm entering a position, I'll be losing terribly to slippage. So that is why I preferred taking off my call rather than shorting the put option. Now this 17650 put option, call option, I really don't think will give me any trouble. But you can never say never in this market. So right now this spread is trading for 5 rupees. And in case this call option expands to 5 rupees, then I will definitely be considering then shorting the 17600 put option. It's an extremely low probability situation for that to happen. And yeah, apart from that, with 48 minutes to go for averaging right now, what I will be on the lookout for is there any opportunity to either take credit from the 17600 call option or 17600 put option just as averaging begins, and as we head into averaging, not right now. So we'll keep you posted. As of now, about 1 point down, all said and done. A couple of mistakes made earlier in the day, so that's fine. Basically did not take any undue risk after that to gain back or anything. That recovery mentality should not be there. I'm fine booking a loss and expiry. It's very low probability that in my trading style I will book a loss and expiry, but if I have to book a loss, I have booked losses and expiry. So I will let you know how things go. Okay, continued up move from Bank Nifty, and this is going to be quite a bad expiry for anyone who had shorted Bank Nifty, that's for sure. We would not expect 37,500 to be taken out like that. Yeah, this would have hurt somebody, that's for sure. I hope people got out of trades rather than trying to be quite adamant. But I mean, despite all that strength, that 50 points is not going to just come like that. There's 20 rupees in the 17,600 call now, and this expanded slightly to 3. I mean, anything's possible. It can go. Certainly can go. It's not an impossibility. This expands to 5. I'll be moving up my puts to 17,600, and that is the plan. We'll have to see if that's how things play out. I would expect that we would close quite close to 17,600. This more or less would end up coming here. Okay, here's what happened. So basically, into this up move, the first part of the up move, I moved up my puts to 17,600 at about 8. And my idea was keep a stop loss at 12, because at that point these particular calls had expanded to 4. On the reversal, my stop loss, I had moved up only about 25% of my position. The stop loss on this at 12 got hit. That got hit, and then I rolled them back down, and then we had the second burst of an up move coming in, at which point I started, as this was heading to 4 again, I moved up my puts again. So now this particular position in the market has kind of forced me into this, because at that point there's no credit left in the 17,550 put, and this is going to certainly expand, as we're just 20 points away. So I had no other option but to move this up. Now overall this together is trading at about 8. So if it expands to 10, which is only possible if one of these expands to about 6. So if one of these expands to 6, 7 in that range, I will cut out of that leg. That's more or less the point. So this is trading at 8. If either of these expands to 6, 7, then I will be cutting out of that leg and taking the risk off. This is starting to be very intense, like Bank Nifty 2% move on an expiry day. Yeah. Anyway, I mean, I'm just more or less pretty set in terms of what my plan is. So not too much of brain to use, but with IT like having this slight pickup move and then Bank Nifty having this continued breakout towards the close, that really would have thrown a lot of people off. So we'll keep you posted. There's about 23 minutes to go for average. Okay, we're at the day's high, and it's reaching a point where there's no credit left in my short put option. I'm looking at perhaps with 1/5 my put side position to short the 17,650 put, but that's only if this expands to about 6, 7. This expands to 6, 7. First of all, my hedge itself is the next strike, so the only thing to do would be to get out of this position, because rolling it up, I've now reached the point where I'm just next to my hedge. So yeah, so that won't make too much sense. I will have to take credit from my put side. We'll have to see if it is avoidable or unavoidable. That will depend on what happens here. Right into averaging, if we make a stiff up move, then most likely I will have to do that. Also, I will set a pretty strict stop loss. Currently, I can gain about 6 points from my short position. So in case I start losing about 3 points, I'll just exit the call side completely. If it's from the call side, and call it a day. Finally, just as we head into averaging, we are now break even for the day. Okay, we are trading at the absolute high of the day with 3 minutes to go for averaging. My exit on this will be at 6 rupees, or at least the management will be at 6 rupees. Basically, I can gain about 5.5, or if I lose anything from there, it will be about losing off 2 points, and probably will get the opportunity to take some put credit also. The way I'm seeing it is we're trading at the day's high. This has no intrinsic value, extrinsic value of 4 points. You'll have to look at the 17,650 put option, which is trading for 21. So here it's trading at 22. This has intrinsic value of 15, but time value of 7. Right. So as far as risk that is being priced in with time, there's more risk that is being priced in the put option, wherein people are expecting to averaging. There's higher probability that we move lower than higher. Now, that's basically why I'm still holding this, but otherwise also the risk reward is pretty good. Now, in case this expands to 6, which basically it has to double from here for it to expand to 6, I will be moving up 1/4 my quantity of puts from 17,600 to 17,650. And in case this expands, really starts to rocket out of control, I will just take the stop loss on the call at around 7, 8. That's about it. As of now, finally, after everything, 1.5 points in the green, and 2 minutes to go for averaging. One of two things will happen into averaging. What I'm working with is that either we will have a down move at least till 17,600 or so, or we will just hold in between 17,600, 17,650 and expire there. So we'll keep you posted. Time is 2:59, 1 minute to go for averaging, and seems to be some strength building in Bank Nifty just as we're heading to averaging. So it kind of works like this into averaging. This 15 rupees, which now the put has crashed, has to go to 0 for this to have value. So that is always there. But now there is absolutely no credit left on my put. We'll have to be wary of this expansion. Okay, we're into averaging, and as of now into averaging, we're not moving. So we are holding, and that is leading to, I mean, the longer an averaging that we spend below 16,650, the more the chance that this call is going to be worth absolutely nothing. We're currently 8 points below, and this is worth 0, but it's trading at 4. Now my idea will be, if we do start heading higher, I will start moving my puts to 17,650. If this expands to 6, I'm not going to be squaring it off anymore, because now the game is completely changed. It is deeply in my favor. So if that happens, then I will be moving up my puts here, and then I will have a stop loss on the entire position. I don't expect this call, at least in the first 5 minutes, if we don't head above 17,650, then this call will not retain any value, because it is a weighted average. Many people keep asking, what is averaging? You keep talking about averaging. Nothing. But the Nifty is not settled based on where Nifty closes. Nifty is settled based on where the average price of Nifty has been in the last 30 minutes. That's why even though we're holding so close here, immediately this call is crashing, because we're not heading higher. Now, it's not that if we end up closing above 17,650, there will be value in this call. No, if the average of Nifty during the entire period of the last half an hour is above a particular strike, only then that strike is in the money. So yeah, now right now, considering that my call has given up value, and I'm not having to do anything to manage it, I will let all of these positions expire worthless. Now I'm sure, yeah, with that red candle, it kind of sealed the fate of that particular call option, and it has given up all of its value. Just like that, it crashed in no time. In about a minute's time, it crashed by 2.5 points. So yeah, now what I'm going to do is I'm going to cover how to manage bleeding ITC positions. I'll make a clip on that, and yeah, I hope you had a good expiry. I hope you were definitely long in the market, especially long Bank Nifty perhaps. And yeah, in this market, it has now become an absolute crime to try and short, and the punishment will be bankruptcy. There will come a time in the market when people can short, but like I've been saying this over all my videos, don't short the market. Don't try to call tops. Don't try to say that, yeah, this is where it ends. The market is in a bubble. Yes, the market is in a bubble. The whole world knows the market is in a bubble. Every market is in a bubble, not just the stock market. The real estate market is in a bubble. Every asset class is in a bubble. Commodities are in a bubble. But that's because money is available so cheap right now. They don't know where else to put it to beat inflation. And it's all finding its ways into assets. And yeah, don't short the market. I think, I don't know if there are any people who are shorting this market that are still alive, because so many people blown their entire accounts because they shorted the market. They thought once 17,000 touch, there's no way we head higher. It's hardly been a month and we're already closer to 18,000 than we are to 17,000. So yeah. Okay, a sudden down move. Just I was going to post my order book. Expanded the puts. I don't know. Some people must have panicked, gotten out of the puts, because the averages, it's been like 17 minutes into averaging and we've held at high levels. Into the down move, I'm not sure why some people exited the put as high as 1 rupee, I think, at 17,600. You just see. Yeah, 1.2 rupees. Not sure why. basically impossible to give value to this put option. I mean, we'll have to now head lower by at least 50 points and hold there for the last 13 minutes for there to be value in this put option. If this put option has to have value, then this call option should have no value. It has 26 points in it currently. So this 27 has to go to 0 for this put option to have any value. Okay, so there is 7 minutes to go. I'm not going to be squaring off these options. I'll let them expire worthless. And yeah, after what is remaining, my position should give up another 10 paisa. So it'll be just shy of 260. And yeah, overall, all said and done, I think the first part I was a little unhappy with my management. I think I was unwilling to take that risk on the downside. I think there's a part of you which tells you that, look, we've been running up forever. So like, do not take risk on trades which have a long bias. And yeah, at one point you can say I even moved my calls down to 17,550, right? That would have really ended up hurting me, but got out of it quickly, and I'm happier with the second half of management than the first half. And yeah, there's all kinds of other things, but all said and done, it's an expiry in the green, and that should be good enough. Yeah, thank you so much for watching, and I will catch you tomorrow. Take care.
Thank you for watching. Please post any questions you have in the comment section. Also, do not forget to like and share the video and subscribe to the channel. To find us on Twitter, Telegram and Facebook, use the username NiftyBN. Also, we post some of our trades to the community tab. So do not forget to check that from time to time.